So we are trying to produce a factor model for stock options. I will briefly give you a summary of our paper first, and I will continue with the model, motivation, and results. So in this paper, we introduce a theoretical model that relates expected delta H option returns to differences between risk-neutral and physical return distributions. And motivated by this theory, we introduce an empirical factor model for individual equity option returns. The model has a total of 6 factors, including the option market factor. And the 5 factors, excluding the market, basically, the 3 of them are really linearly related to the expected option returns. They are basically the spreads between risk-neutral and physical measures of volatility, skewness, and kurtosis, because we truncate the Taylor series expansion at 4, which I'm going to discuss. Plus, we have these big nonlinear term in the model that we proxy with option illiquidity and option price. And once we introduce this factor model, we basically evaluate the performance, empirical performance of this model, and we also horse race between our model and existing factor models. And we show that Sharpe ratio of each factor is greater than the Sharpe ratio of existing factors. And also the Sharpe ratio of the tangency portfolio of our factor model is greater than existing model's Sharpe ratio tangency portfolio. And then we basically do the standard GRS test and look at absolute alpha of large number of test assets. We have a total of 128 test assets constructed with option and stock characteristics. And we test basically the reduction in absolute return on these test assets. And we show that absolute alpha on these test assets is significantly reduced by our factor model. Since SDF, or stochastic discount factor, is a linear transformation of the tangency portfolio, we basically test whether the SDF implied by our model produces greater risk-return opportunities in the options market, and also if it improves the cross-sectional pricing of individual equity options. The answer to those 2 questions are yes, as I'm going to discuss. The SDF implied by our model improves the cross-sectional pricing and also creates or captures a greater risk-return opportunities in the options market. So one of the main takeaways, or I should say practical implication of our findings is that as a portfolio manager, if you are interested in finding risk-adjusted performance of your option portfolios, if you rely on standard factor models or even CAPM, you obtain large abnormal returns on your option sort portfolios. But our results basically show that these large abnormal returns are in fact compensation for volatility, tail risk, and liquid risks in the market. So these are, I would say, the main takeaway from an empirical standpoint. So this is basically the summary of our paper. That's what we are trying to accomplish. Next, I will move to motivation. So what is our motivation? Why are we working on this paper? Why would an editor or a referee would care about this paper? So first, we have a few bullet points here. First, as we all know, the factor structure that captures cross-sectional variation asset returns is a central question in asset pricing. So especially for stock literature, we've been working on this for about 40 years now. And that's why we have this vast literature that already introduced various factor models for stock returns, right? I mean, 3-factor from a French model, 1993, is the most cited article in JFE. Then they extended in 2015 article, again, JFE, right, with investment and profitability factors. There is also another extension, 6-factor model, right, with momentum in 2018. So we have these papers, and also we have the Q-factor model by Ho et al., 2015 RFS, and 2020 review of finance extension is with expected growth factor. So these 2 factor models by Fama-French and Ho et al. Are developed within a rational asset pricing framework, right? So it's basically either developed in an ICAPM or dividend discount factor model or dividend growth model or production-based asset pricing model. So these are rational models. And then we also have, on the other side, the mispricing or behavioral factor models, one by Stambo and Yuan, 2017, and then Kent Daniel, David Hirschleifer, and Son in RFS, 2020. These are more mispricing behavioral factor models, but this literature is well established. And there are also a number of extensions of this literature, say liquidity risk factor by Pastor and Stambo, and so on. There is also more recently a growing literature that expanded the study of these factor models to other asset classes, right? So we have a factor model for currency, commodity futures, corporate bonds with my colleagues at Georgetown, and then we have a factor model for cryptocurrency, 2020 JF. So, of course, this literature is not nearly as extensive as the stock factor literature, but our point is basically the factor structure for option returns is far less understood. There are a number of articles that relates stock and option characteristics to future returns, but the factor model for option returns is far less understood. So this is one of our motivations. So we are trying to fill in this gap. And our second motivation is really the theory, the existing theoretical evidence. The literature, the existing literature does not provide clear theoretical guidance on what delta hedge option returns should look like. We tend to rely on Black-Scholes, and according to Black-Scholes, as a simplistic benchmark, excess return on delta hedge equity option is supposed to be zero, right? So you write a call option, you buy delta shares of the stock, the portfolio is supposed to generate risk-free rate, so excess return is supposed to be zero in Black-Scholes world, right? But what we do is we start with investigating or examining the empirical distribution of delta hedged option returns in our sample, and we show that there are significant departures from normality, okay? So the returns are not normally distributed, the average or median return, excess return is not zero, is actually positive and highly significant. And there are significant amount of skewness and kurtosis as well. So basically we provide a theoretically motivated and more realistic benchmark that relates expected delta hedge option returns to spreads between risk neutral and physical return distribution. So this is one of our motivations, okay? So basically to provide some guidance, theoretical guidance to the literature on delta hedge option returns, what it should look like. Well, the next motivation is actually the popularity and the growth in market size, right? So the options are becoming increasingly or playing increasingly important role for both retail investors and fund managers, right? So this, given that the growth, the market capitalization, popularity of the options market, we think understanding the key drivers of option return predictability and introducing a factor model for option returns and providing a good benchmark would be an important question for both academics and market professionals. That's another motivation for us. And then next motivation is investor clientele. So we have totally different, investors in equity and options market, right? Because the underlying cause of trading options can be quite different, right? From trading stocks. Well, option traders trade based on data-driven information, volatility expectations, speculation and hedging may play a role. Whereas, naive retail investors, they have strong behavioral biases, they have limited attention, as opposed to option traders being sophisticated with stronger quant analytical skills. So basically the point is here, there is significant difference or the wedge between option trading behavior. So that's why we can't simply rely on a factor model on the underlying asset. So the options have some unique features from the viewpoint of investors and trading behavior. All right. So that's kind of our motivation. That's why we've been working on this paper. Now, I will move to the model. I will give you a brief description of the model and the justification of the model ingredients, okay? So we start with defining return to selling a delta neutral call. There is nothing new here. This is the standard holding period return for delta neutral call, and this is the call payoff. But one of our innovations at the start of the model is that we define expected delta hedge option return as a weighted average of the expected stock return and expected return on call option. Or I should say expected return on a strategy that buys a call option at T and sells that time T-1. So with some algebra, you can actually get this expression, which defines expected holding period return on delta hedge option position as the weighted average of expected stock return and expected option return. Then the rest is basically 15-page long appendix that is more like, that felt to me first when I saw it, right? Thanks to Fousseni, it felt like a root canal at the dentist office. So I had to go through it line by line, all right? So I'll give you the gist of it, all right? So we start with the fundamental theorem of asset pricing, right? The expected delta hedge option return here is basically Well, this is the standard. I don't want to say anything specific here, but it's mostly telling us that the cross-sectional difference in expected returns is captured by the covariance of returns and the stochastic discount factor. So M is stochastic discount factor here, right? Or you can rewrite this as basically expected return as exposure to systematic risk plus the price of risk, right? But here the key innovation is under no arbitrage conditions, we apply this Redin-Nikodym theorem that basically transforms, that makes us easily play with risk neutral and physical distributions on expected returns. And eventually, what we get is expected growth in the stochastic discount factor becomes this nonlinear implicit function as a projection of M on R, all right? So here, we are relying on the methodology developed by Fousseni and his co-authors, Greg Wilkov and Dim, and also this RFS article, Kadan and Tang. So based on these articles, we basically rely on Taylor series expansions. So this implicit function G is approximated, or it can be explicitly written as Taylor series expansion, but we truncate the Taylor series expansion at order 4, because beyond kurtosis, we don't have economic meaning of 5th or 6th order moments. So eventually we get this expression. So expected holding period return becomes MRP is a shortcut to spreads between risk neutral and physical variance, skewness and kurtosis. As I said before, the sum goes from 2 to 4. So we could, keep extending this, but we wouldn't be able to, estimate them with reasonably low measurement error. So this part is easy. This part is very complicated. Okay, so there are so many terms here. So let me just briefly talk about this. The first term in that expression is basically states that expected delta edge option return is a function of the difference between physical and risk neutral measures of volatility, skewness, and kurtosis. I think this makes sense because the risk premia are supposed to be fully captured by the differences between physical and risk neutral distributions. That means these vol, skew, and kurtosis spreads are supposed to contain significant information for predicted future returns. However, the remaining part of that equation is highly nonlinear function of a lot of things. Okay, stock price, option price, risk neutral measures of market beta. So if you put a microscope on those terms in the appendix, you will identify these terms. However, we can't really come up with more parsimonies and practical factor models. So here we had to rely on some simplifications. So we rely on stylized facts, some empirical results in the literature, such as like low price assets have market beta, high volatility and low liquidity, and illiquid assets also have skewed fat tail return distributions, right? And with significant volatility and risk premia. So that's why we basically knock that term out with option price and option illiquidity. And once we use option price and option illiquidity, which are in fact in that nonlinear term, you actually knock out stock price as well, because it's the factor constructed based on option price, option liquidity supersedes the impact of stock price. So that's how we get around of that nonlinear model in a nutshell, all right? But I'm going to justify this empirically as well, all right? So the spreads are easy to justify. It's literally there. It's the other two terms are in the model, but if we are proxying that highly nonlinear, big, large component with those two variables. So data is standard option metrics 1996 to 2019, and we are relying on my co-author's RFS article on standard filters. So we have approximately 800 options per month. These are relatively liquid, optionable stocks. But we pick one at-the-money option, one at-the-money short-term call option. Average maturity is about 50 days, close to. And we work with, as I said before, return to delta neutral call writing, all right? So these are our monthly returns. And now let me define the key variables. So these are the model's ingredients based on the model. So illiquidity is defined as the option bid-ask spread divided by the average of bid and ask. The option price is the average bid and ask last and month. And then the physical measures of or realized measures of volatility, skewness, and kurtosis, they are defined using daily returns over the past 1 month or past 1 year. Results are pretty much the same. And risk neutral measures of vol, skew, and kurtosis are calculated using Bakshi-Kappa-Diamadan, the standard area under the integral. Okay. Okay. Now, next step is okay. So the next step is to show that the simplistic benchmark, the Black-Scholes, doesn't work. Basically, average excess return on delta hedge options is not zero. So what we did was, once we generate our delta hedge option returns for calls and puts, we calculated simple descriptive stats. Okay, so the average return is huge if you compare them with stock, but if you are familiar with the option return data, these numbers are not unusual, these are not surprising. So these are average and median monthly returns. They are, of course, highly skewed, and they have significant kurtosis. Okay, so these are call riding, that's why the numbers are positive here. All right. So, but as you can see, there is significant departures from normality if you do the Jark-Bera test. And then we dig into volatility, skewness, and kurtosis for physical and risk-neutral measures. All right. So these are value-weighted average of stock level. These are underlying assets, underlying stocks, vol skew and kurtosis here in this picture, right? So basically, the value-weighted average or median doesn't make much of a difference. There is significant time series variation and nonlinearity in volatility, skewness, and kurtosis. So, you know, you can actually break all the assumptions of Black-Scholes here, all right? So we need a more realistic benchmark. Now, next step is to justify, now empirically justify the model's ingredients, whether the 5 characteristics that we picked based on the model, do they actually predict future option returns, right? So these are standard portfolio sorts.
Excuse me one moment.
Okay. Yeah. Any question? All right. So what we did was we basically sort individual equity options into quantile portfolios. Okay, these are standard sorts based on option illiquidity, option price, the variance risk premia, vol spread, skewness, and kurtosis spread. Then we calculate 1 month at average returns, right? Using equal weight average, stock value weight average, or option value weight average. So the weighting scheme doesn't matter. Qualitatively speaking, we obtain the same results. So these variables, these option characteristics, predict future option returns, okay? So we justify them empirically. But if you look at the relative magnitudes of these return spreads, skewness spread is relatively weaker compared to others, all right? Still economically sizable. But for option sort portfolios, it is smaller, but it is still significant statistically, all right? Now, next, we construct our factors. Here we are following standard Fama-French methodology. Think of this as constructing SMB and HML factors. 2 portfolios sorted by, let's say, size, market cap, like in the case of SMB and HML, and 3 portfolios sorted by book to market ratio, right? 30th and 70th percentile. We are doing the same here, except that we are sorting options based on option size. That's the first sort variable. Well, these are independent sorts. There is no first or second. At the end, we are taking the intersection of 2 by 3 independent sorts. Option size, and then each of the option characteristics, okay? So for example, the volatility factor is constructed based on 2 portfolios sorted by option size, 3 portfolios sorted by the volatility spread, all right? So this will generate basically 5 factors for us, 5 new factors, okay? The average of these 2 minus average of these 2, all right? So think of this as, for example, the average of big and small for stocks in high book to market ratio minus the average of big and small stocks in low book to market ratio. This would give you HML in the case of French. This generates 5 different factors for us, but the construction methodology is exactly the same. Now, next we look at average return on these factors, whether average returns are significant, okay, and if they are explained by existing factor models, right? So as you can see, the average return on liquidity, price, volatility, skewness, and kurtosis factors are highly significant. Again, consistent with the earlier table. Relatively speaking, skewness factor generates relatively smaller premium, all right? But they are all significant. Of course, the market factor has largest average return as expected. And if you look at the correlations, The correlation between the factors, between the 5 factors, are relatively small, indicating that we are capturing wide variety of risks in the options market. But their correlation with the market factor itself is high, especially the kurtosis factor, the liquidity factor, and these factors also reasonable, decent economic size, meaning market factor could be actually a mixed bag of these factors, right? So we are actually capturing the factor and the market factor. Now, next step is to test if existing factor models explain our factors. Okay, what is the alpha? All right, so these are more like factor spanning tests for each factor. All right, so we use existing factors here. Well, as expected, 3-factor Fama French extended with momentum factor, extended with Pasteur-Stambo liquid risk factor, or 5-factor Fama French with investment profitability, extended with momentum, or Q factor, or 4 factors of Hoetel, extended expected growth, or Stambo Yuan mispricing factor, DHS mispricing factor, or bond factor model. Okay, they do not explain our factors. Now, option factors. Brian has a paper published recently in the JFE. They have IPCA-based factor model, but that factor model doesn't explain our factors for the simple fact that, well, these guys don't explain either, because these are also option factors. This is more like Koval-Shunwai, Agarwal Naik, Fang and Sheikh, standalone factors. The reason is their IPCA is applied to S&P 500 index returns. Okay, so the factors are not constructed using individual equity options. All right, now we're in the process of looking at IPCA using our own option sample. All right, so that IPCA factor model should have reasonable power, because the latent factors coming out of the IPCA should proxy some of our factors for some reason. And recently, Amit Goyal and Alessio Serrato has a paper on individual equity options run by IPCA, right? So we are trying to basically replicate that. If there is some form of explanation from the IPCA, I assume it would, but I don't know if it's going to explain all, but I wouldn't be surprised if it explains some meaning in that case. My hunch is latent factors would be proxying some of these factors. That's my interpretation. That would be. Okay, next, we basically look at the test assets. We form 35 test assets. These are portfolios, long-short portfolios constructed by sorting equity options into long-short portfolios based on 35 option characteristics. Okay, so these are basically sorts based on gamma, vega, theta, embedded leverage, volatile term structure, vol of vol. I mean, we have pretty much anything we could calculate here. It's a large number, like momentum, the paper by Steve Heston and Chris Jones, right? So we explain momentum here, for example, as you can see. So let me give you the summary of these results. First of all, the average return on these 35 test assets constructed using 35 option characteristics is 1.6% per month, approximately, okay? And we reduced this return spread to 39 basis points per month, right? So we explain approximately 1.24% of the total, like the average across these 35 portfolios of 1.63. And we cannot explain 2 out of 35 test assets if we look at the significance of alpha, because once we construct these 35 test assets, we basically run factor spanning regressions, right? These portfolio return spreads are on the left-hand side, and on the right-hand side, we have our 6-factor model, and we look at the alpha. So 2 out of 35 is not explained by our factor model. And then we generate another set of test assets. Those are based on 93 stock characteristics. These are standard Green et al. 2017 RFS article. I'm sure, if not all of you, most of you are familiar, right, with the paper. So we have a total of 128 test assets here, all right? And we run factor spanning regressions, and we cannot explain 18 out of 128 test assets. And we reduce the return spread from 1.11% per month average across 128 test assets to 47 basis points per month. So our factor model is very powerful, all right? Now, we run a horse race, but again, this horse race is not, I would say it's not fair in the sense that these are stock factor models, bond factor models, but option factor models, but they are really constructed based on S&P 500 index return. So here is, as you can see, as I said before, we cannot explain 2 out of 35 portfolios, but if you look at other factor models, such as the one I proposed with my colleagues at Georgetown, a bond factor model. Our factor model do not explain 26 out of 35, right? So, but this is a bond factor model, right? So there is this clearly divergence between stock bond versus the option markets. You can justify through investors trading or other risk factors that's more prominent in the options market. And then we also calculate the average absolute alpha. As you can see, is much smaller for our factor model. And then we look at adjust R square from these factor spanning relations. The adjust R square is average adjust R square is about 22% for those 25 test assets. If you look at other factor models, it's around 3-4, right? So we replicate the same thing for 128 test assets, all right? 35 option, 93 stock. Adjust R square is 18% here, and the other factor models around, is very small. And also the number of test assets not explained by these factor models versus us, all right? So we basically perform better than these factor models, all right, in the horse race. Then the next step is whether we explain common return variation in individual equity options. So we do the PC analysis, right? So we look at the principal components of our 35 long-short portfolios. So as you can see, we explain in the cumulative total variance, we explain up to 70% of the total variance in option sorted portfolios, all right? Well, the first principal component, largely proxying for the market, is explains up to 31%. The second principal component explains 14%, and so on. But the first 6 principal components explains up to 70%, all right? Now, the question is, what are they proxying for, right? So we look at the correlation between these PC portfolios and our factors. The first principal component, not surprisingly, is highly correlated with the market and kurtosis factor, all right? So these two capturing the larger correlation. The second PC is highly correlated volatility and somewhat kurtosis. The third one is highly correlated with price and illiquidity. The fourth one is highly correlated skewness, and as you can see, the average return, I'm going to talk about this soon, is the smallest among these PC sort portfolios. So it is actually another confirming evidence that the fourth one is proxying for this. The fifth one is kind of is a mixed bag of these vol-skew and kurtosis spreads. But what we did was we basically calculate the average return on these PC sort portfolios. So since the first one is this giant, the factor that's more like a combination of market and the kurtosis, these are the largest return factors. The average return is huge. This is the second principal components. Again, this is relatively small, but it's actually capturing skewness. That's why, if you remember, skewness spread created, relatively speaking, smallest economic significance. But the most important finding here, I think, in this table is when we run the factor spanning relations on these PC sorted portfolios, our 6-factor model explains these PC sorted portfolios. So that means you really need these 6 factors to span the cross-sectional variation in option returns. Okay, so this is, I think, I really find this result very powerful. That shows strong support for our factor model to explain common return variation, the co-movement in option returns. Next, we look at Sharpe ratios. Here, we calculate Sharpe ratio of each factor as well as Sharpe ratio of the tangency portfolio, all right? So a typical Sharpe ratio, most of us familiar with, if you are working with stock data, is the S&P 500 index. Annualized Sharpe ratio is about 0.5, depending on the sample period, right? That's what you get, 0.5. Well, momentum for some time periods, you get higher than 1 annualized Sharpe ratio. But these are huge numbers. But if you are familiar with the option data, these are not unusual. These are the numbers you get, all right? But these are a little bit higher than usual because of the strength of these variables. But in any case, let me show you some numbers. For example, I highlighted the ones that are greater than 1 annualized Sharpe ratio, right? So these are Brine's IPCA factors, greater than 1. So this is Koval and Shumway, greater than 1. Fang and Sheh, greater than 1. Downside risk and liquidity risk factors from bond, those are greater than 1. But our Sharpe ratios are higher, all right? But most importantly, the tangency portfolio, right? That's what we care eventually, because that is linked to STF. Why? Because STF is an affine transformation of the tangency portfolio. That's why we care about tangency, Sharpe ratio of the tangency portfolio, right? Do we extend? We do. So what we do here is we take these 6 vectors, okay, and then we find the Sharpe ratio of the tangency portfolio. We do it using in-sample approach, meaning we use the full sample to estimate variance covariance metrics. Well, they are not achievable, they are not practical, but then we do it expanding window. These are true out-of-sample tangency portfolio construction. Okay, there is really, you can do this, achievable returns. So if you look at the numbers, the Sharpe ratio of tangency portfolio is huge, but this is not unusual based on these numbers. Next, what we did was, which not reported here, but we excluded the market. We said, okay, how do we do with respect to the market? We take our 5 factors, okay, left the market alone, and the tangency calculate tangency portfolio, Sharpe ratio of the tangency portfolio, and it's around 7. Okay, so we basically compare to the market, right? We extend the opportunity set. So think about STF, right? Think about markets, the efficient frontier from market mean variance to CAPM. So our STF improves both cross-sectional pricing of individual equity options, and also improves or produces greater risk return opportunities in the options market. All right, and we calculated Sharpe ratio of the tangency portfolios of existing factor models. Okay. So the largest ones are, again, Brian's factor model or some others, but around, let's say 1.82, right? These are the Sharpe ratio tangency portfolio, but they are not nearly as strong as our factor models, okay? But this is not unusual, because, I wouldn't expect stock bond factor models to produce better. Okay, now, next, these are kind of final set of analysis in the paper in terms of empirics. We link this, we try to identify the performance of the stochastic discount factor implied by our factor model. So it's really difficult to come up with a stochastic. It's very complex, right? There's too much information, so it's difficult to come up with an exact discount factor coming out of a factor model. So what we did was, we basically tried to identify approximate price of risk attached to stochastic discount factor. Okay, so we basically start with the CAPM, right? According to CAPM, I'm supposed to regress, let's say, market on the variance, right? And then the expected market will be more or less a proxy for the STF implied by the CAPM. And this is actually the first evidence in the literature. We can make this a bigger deal, actually, if we investigate this a little bit further, or put bells and whistles around it. But we find a significant risk-return trade-off in the options market. It's positive. Okay, so market return regress on the variance of the market. We find positive intertemporal relation, and out of this regression, we generate the STF, approximate STF. I'm going to talk about those results in a second. But then we look at each one of our factors, regress market factor on our factors, and create an approximate STF, all right? And then we basically run second stage Fama-Macbeth regressions and try to find option risk premia, both at the option level, Fama-Macbeth, and portfolio level, okay? So think of this as option exposure to approximate STF implied by CAPM. This is the option exposure to approximate STF coming out of our factor model. Or you can treat this as option exposure to a weighted average of our factor model. Okay, and as you know, if we claim that our factor model is actually a risk model, meaning it can be justified in a rational asset pricing framework, we are supposed to find these factor exposures to be priced, right? And we do, as you can see in the Fama-Macbeth regressions. You can treat this in a simplistic framework. You can take this as simple CAPM test, if you like. Take the stock literature, estimate market beta for each stock. Once you have the beta, run Fama-Macbeth regressions or form beta sorted portfolios. What do you get for stock? You get nothing, either nothing, or you may get betting as beta effect, maybe negative alpha spread, right? But here for option, you get this weak positive relation for kappa beta. For our SDF beta, it's very significant, highly significant. And when we put them together, actually R factor beta supersedes the kappa beta. Okay, it's captured. Then we form portfolios based on this SDF beta. Okay, so these are portfolios, quantile portfolios of equity options sorted by these betas. And if you calculate equal weighted, stock value weighted, or option value weighted averages, the return spreads are here, small but significant, consistent with this evidence, right? But if you do this for our SDF beta, the numbers are huge. Okay, so that's why we have this extended risk return opportunity that's basically captured by our factor model. All right. So the SDF, I would say, since it is a linear transformation of the tangency portfolio, if you add them up, if you take the results I just discussed, I summarized in this table and this table, right? It makes sense, right? So let me briefly conclude. So in this paper, we propose a theoretically motivated factor model for option returns, and in this model, we relate expected option returns to distribution characteristics of individual stocks and options. And then we evaluate the empirical performance of our factor model and horse race with existing models. And we show that the Sharpe ratio of each factor is greater than existing factors, Sharpe ratios, and also the tangency portfolio of our factor model produces larger Sharpe ratios. And we explain larger realized return spreads on test assets. And the SDF implied by our model produces greater risk return opportunities and also improves cross-sectional pricing of equity options. And one practical takeaway from our paper, I would say, is these large abnormal returns that people talk about. Also, if you talk to fund managers on their option portfolios, they brag about these large abnormal returns. They tend to basically capture, or they are compensation for volatility, tail jump risk and liquidity risk. So that's why, as an investor, if one is trying to find the true magnitude of the risk-adjusted performance of their option portfolios, they should take into account their portfolio exposure to our factors. With that, I conclude.
Thank you, Turan. The chat has been quiet until very recently, so I guess that's why we have plenty of time ahead of us for our colleagues to unmute themselves and ask you questions directly. I guess in the chat now we have a bit of action regarding the fact that you're introducing yet new factors, which I guess is a criticism. But they are relatively different to what we've seen before, so that's interesting. I'll start with my question while our colleagues are getting unshy and do unmute themselves. So Aurelio Vasquez was presenting at SIBO last Friday, also a paper about option returns and finding the proper factors, and they had a very different approach. So I see that you start from the theory and the moments and the premium for these moments. They were starting from a very statistical perspective, and it seemed like the battery of statistical tests that they were throwing at the data was implying that 3 factors should be plenty and maybe 4, but you should stop there. And so I'm kind of wondering why we have this very different kind of set of results here. Where is it because you start from the 3 moments and these do not span everything, or what's going on here?
Yeah, I mean, the reason is basically the first 3 moments, according to our model, you need to have volatility, skewness, and kurtosis, and each one of them are important. If anyone in any factor model is missing, suppose taking into account volatility, but missing out skewness and kurtosis, it's a big miss. As I showed you, kurtosis plays a big role. And I actually, when I started this, I thought that skewness would play a bigger role, okay? But surprisingly for option returns, kurtosis is playing a bigger role. So skewness and kurtosis should be there. And another reason is, let me come back to the model. There is this second term, Fousseni may talk about this as well. It's very difficult to disentangle, and it has in it option price, stock price, some form of liquidity proxies, or risk neutral co-moments actually. All right. So the model is so complicated. That's why no one, in my view, didn't attempt to express expected delta hedge option return. So that's why we are trying to capture that. To tell you the truth, we might be missing a few things there. For example, when you look at our 35 test assets, we cannot explain gamma and theta, for example. Okay. All right. So those are the two variables that we cannot explain. We explain the rest, like momentum, vol-to term structure, vol-of-vol, vol spreads, some behavioral type variables even. But so my quick response to your question is, if you start with an empirical approach, with a statistical approach, like IPCA approach, you may end up with maybe 3 or 4 or 5 latent factors. It's possible, right? But I'm not sure if you can tie them to, I assume they should be tied to one of our factors, to some of our factors. But our approach is more theoretical. I mean, it's really the papers are in my view different. We do cite that paper in our paper. They have 3 latent factors, I know, and they use Martin Leto and Marcus Pelger's approach, if I remember correctly. The 2020 article by Martin and Marcus Pelger, they have a paper. They are using their approach, not IPCA, but the Leto Pelger approach. So, I mean, I assume we have some. If I remember correctly, they have the variances premia there. That's for sure. But the other 2 variables, I don't know. I mean, they don't have it specifically. My point is, when they look at the correlations between latent factors, one of them was highly correlated variances premia. So we have one factor in common, but I don't know the other 2. What are they?
Well, I do remember that the vol-of-vol is important too, so that's probably very related to your kurtosis factor. It's just intriguing that these factors are so important, that you have, the skewness and the kurtosis, and that yet you don't explain the performances of portfolios sorted on gammas, which you would think, are jump portfolios in a sense, right?
Yes. We reduce the spread. Don't get we reduce the return spread.
Yeah, no, I understand.
We can't explain it fully. We can't explain it fully. Yeah.
Interesting. I think it goes along the line of what Catherine Shalin has been posting in the chat also, regarding the fact that the Greeks of the options are important, and maybe there's something in those Greeks that is not fully explained by the factors, but that's definitely food for thoughts. That's for sure. So more questions from the crowd now that I have been hugging. Yeah, Wei Chen is having a question, so I'll hand out the mic.
Hi, Hui, good to see you.
Hi, Turan. This is a fascinating paper. So I have a question about the way you construct these factors. I think this is actually related to the question in the comment as well. So basically, some of these characteristics, it seems like they are, or the way you construct these factors. For example, think about the option liquidity, right? We know that this kind of relative spreads have predictable relations to characteristics such as moneyness and time to maturity. So in a way, we probably don't want to compare the relative spreads of a out-of-the-money option of a relatively liquid option to a at-the-money option of a relatively illiquid option, where both options might show up to have relatively similar relative spreads, even though they are a very different spectrum in terms of moneyness. So I'm actually wondering whether you could have do this kind of a factor construction in a way that controls for the option characteristics in a more clean way. And in fact, because it's what I like the best about this is that it is theoretically motivated, and there are predictable variations along these dimensions that you could actually control for. Anyway, so this is just one thought which might help you clean the option factor.
Thank you so much. It's a very valid point, Hui. We restrict our sample to ATM, short-term options. We don't want actually are sample to be contaminated by maturity and moneyness effects, to be honest with you. But you have a very good point, because if we generate our option sample with different moneyness and different maturity, then they would be naturally a part of the story. Like if you think of out of the money put minus at the money call, that's your skewness measure pretty much, for example. But that's a very good point. We can actually maybe replicate this with different moneyness and different maturity, still fixing in that option sample. Thank you. Yeah, Petra, I guess.
Thank you. My question is, how would you compare the fit of this factor model with the big data paper you wrote with Beckmeyer, Merki, and Weigert?
Very nice. People are following my papers. Good. People are reading my papers. I'm glad. Well, it's a very good point. Well, in that paper, we are not trying to come up with a factor model. It's not a factor model paper. It's basically whether stock characteristics or option characteristics are more powerful to predict cross-sectional variation in option terms. Okay, so that's one. And the other point that we are making in that paper is non-linear machine learning models produce better or provides more accurate characterization of option returns compared to linear machine learning models. So in that paper, the objective is basically to compare linear versus non-linear machine learning models, their performance using stock versus option characteristics. And our main takeaway in that paper is option characteristics do better than stock characteristics in predicting future option returns, but stock characteristics contribute to option return predictability. But papers are significantly different, but there is one main find that is orthogonal, which is we find the option characteristics matter more than stock characteristics. That's what we find here also. That's the main essence in this paper. But it's a totally different paper. There is no machine learning here. There is no sophisticated econometric methodology here. This is simple, from a French portfolio formation and, from a Macbeth regressions. And the other paper had nothing to do with factor models. But thank you for the question. There are some common elements, but I would say there are largely orthogonal, these two papers. Thank you, Petra.
Anyone else?